So good afternoon, everyone, and thanks for joining us on this webinar today, where we'll talk to Dan Miles, the Managing Director and Co-Chief Investment Officer from Innova Asset Management. They're the research team and investment team behind Liberum Financial. He'll be answering any questions you may have regarding the COVID-19 impact on share markets, including addressing the question on many investors' minds, which is now a good time to invest. We've allowed an hour, and our rough plan is for Dan to run through his thoughts on a number of questions that I've prepared for approximately 30 to 45 minutes, and then at the end, allow any of the participants to ask Dan anything that's on their mind. So feel free to pose any questions as we go via the chat function in your Zoom browser, or at the end you can hit the button that says raise your hand, and I'll turn your mic on and you can ask the question. So a bit about Dan. So Dan's led Innova since 2010 and is responsible for the overall portfolio management of Innova's managed account portfolios. He also oversees the design and refinement of Innova's unique approach to managing investment risk. Dan is a regular contributor to media discussions for the likes of Sky News on issues affecting the investment and advice industries, and has co-written a number of research reports on portfolio construction and risk management, including in partnership with global actuarial firm Millman. Dan holds a graduate certificate in applied finance from the Macquarie University, where he was awarded the University Prize for Risk and Portfolio Construction. He also holds a Bachelor of Commerce of Finance with merit and a Bachelor of Science, both from the University of New South Wales. His science major was in biology, so he has an in-depth understanding of the science behind what's going on in the world at the moment. So Dan, thanks for joining us. I think we all understand how we got to this point, and that there are sort of two different stories playing out. Firstly, there's what's happening in the real economy as we and the rest of the world have gone into some form of lockdown. But there's also what's happened and what is happening in share markets. So to start with the real economy, I think it's obviously likely that we're headed for, or if not in some type of global recession. What does that mean for us? And can we expect the effects to be as severe as something like the Great Depression?
So, it basically means that GDP growth is going to be a lot lower and negative for a period of time. There's a large debate as to how long that period will be. And to be honest, I think anybody that's forecasting GDP growth numbers out to the end of 2020 are kidding themselves, because there's too many unknowns. And whether we enter recession or not, look, recession used to be defined as 2 quarters of negative growth. The economics board and advisory have changed the way in which they define a recession as an extended period of months of negative GDP growth. But the definition doesn't really matter. At the end of the day, what it means to the person on the street is that there's people are spending less, working less, and doing less, and so therefore producing less. Hence, gross domestic product is lower, because it's measured in terms of growth. And if it is growing at a slower rate than it was previously, the number is negative. What that means, people have seen in the press that there are people out of work, in particular in the hospitality and tourism industries have been hit quite hard. There are other areas of the economy that are doing just fine. And how that will play out globally, it depends a lot on how the various economies deal with the virus, with the spread of the virus, and how they deal with it coming out the other side. Because until there's a vaccine available and herd immunity available, there's always the chance of a secondary wave of infection, and how a government is set up to deal with that, and how they approach that will largely determine how long or prolonged and how deep any kind of recession, if we go into recession, is likely to be. Compared to the Great Depression, I don't think we're going to see anything like the Great Depression for a number of reasons. I don't think anybody would argue that on both the fiscal and monetary side that there's been any attempt at prudence. On the monetary side, we've seen the Federal Reserve essentially say that they're going to quantitative easing, or QE infinity. They'll buy anything that they need to be able to provide liquidity to the market to allow the market to function. That's included setting up a special purpose vehicle to buy corporate bonds, which is actually not even within their constitution. And they've said that nothing's off the table. So they could potentially go down the Japanese route and end up buying equities. We've also seen fiscal stimulus. Obviously, we've seen it domestically, but we're seeing it globally by various governments. And that's not what occurred during the period of 1929 to 1932 during the Great Depression, when I think it was it Hoover, with the president at the time, was obsessed with maintaining a fiscal budget surplus. And so you didn't, and you also had a monetary policy at the time, which is now heavily criticised for not providing the level of stimulus that was needed, and tightening at a point in time that was not a very intelligent point in time and caused the Great Depression to extend. Whereas we're seeing the complete opposite from central banks globally right now.
Thanks, Dan. So with all this stimulus that the government and reserve banks around the world are handing out, what obviously comes, mean a large amount of debt. What does that mean for the economies around the world in the long term? How do these get paid back? How does it play out, do you think?
Yeah, it's a really good question, because debt is paid back in a couple of different ways. The first most obvious way is default, right? So I don't think any central bank or any corporate, if they can do it, wants to default. That leads to that can potentially lead to wars. So I don't think that's an avenue people want to follow down. Another way, and the way in which the central banks globally have been trying to do, is to inflate the debt away. If you can spur on a level of inflation that's higher than normal, then you're paying your debt back in real terms at a lower amount. The ideal way is to grow your way out of the debt, the way the US grew out of their debt post World War II. So they had an enormous amount of debt, and they grew their way out of the debt because of increased GDP growth. How the debt will get paid back this time around, to be honest with you, I don't know. I think that we're probably going to enter a period of the economy will not look exactly the same as it did prior to the start of 2020. What is most likely to happen is that we will grow, but we'll grow slowly, and that will go some way towards repairing the fiscal debt that needs to be paid back. As far as the monetary debt, so the liquidity and stimulus sitting on central bank balance sheets, that could potentially be there forever. And the way in which some governments and central banks are looking, in theory, the central bank should be separate from the government, but we're seeing more and more the two of them becoming entwined together, and you're seeing the central bank monetize the debt of the government. And so that may be the way that somewhere like the US deals with their fiscal spending, by the central bank just essentially buying up whatever the treasury issues and holding it on balance sheet infinitum. There is also talk amongst some very esteemed economists about the concept of a debt jubilee. I ascribe a very low probability of that occurring. That's basically where the governments all come together and agree to give each other's debt. I don't think that's going to happen, because the debt levels across nations are not the same, and there are other agendas at play. I mean, you just have to have a look at the trade tensions between the China and the US. I doubt the Chinese are going to forgive US debt that they're owed. So I think a debt jubilee is very unlikely. I think what is more likely to occur is that debt is here to stay on central bank balance sheets for a very long period of time, and that the debt on government balance sheets is either grown out of slowly. I don't think that inflation is going to allow it to be inflated away. However, a lot of the there are a lot of the ingredients in place for future inflation at some point in time. So, we've actually prepared some parts of the portfolio in case that were to occur, because I don't think the probability is zero. But I think the monetization of that debt by the government central bank is more likely, particularly with the growth in and popularity behind concepts such as MMT, which is called modern monetary theory, which there's nothing modern about it. It's just that that it's been given that name because it's had a resurgence, and that's something that someone like Bernie Sanders is very much behind. And that really is where governments spend until they reach full productive capacity, and all the spending is taken on board by the central bank.
Thanks, Dan. Just looking at how do you see in terms of the economy, like how do you see the Australian economy coming out of this, and sort of what's your likely scenario in terms of timeframes and yeah, from what's going on?
Yeah, it's look, I have to say, I can't predict the future. I don't have a crystal ball, so I can only think through what a logical scenario is. And from where we sit and from where we look, I believe that Scott Morrison has done a good job in enforcing what are called suppression mechanisms. So the two primary mechanisms that I've talked about in regards to dealing with an epidemic or a pandemic are mitigation or suppression. And mitigation was essentially, because of the way in which this virus was spread, mitigation wasn't an option. Suppression was pretty much the only option. I don't think that we'll be under a period of suppression for 6 months, the way that it's been spoken about. I think that was put out there to try and shock people into actually behaving in the way that's required to try and mitigate the spread of the virus. What I would like to see, and what I hope is followed, is that we've basically had a blueprint put forward to us by groups like South Korea, where efficient testing and then efficient tracking of those tests are made available to the broader population. And so the vast majority of people can be tested, and those that are tested positive, even though they may not be showing any symptoms, can be traced back to their contact points and those areas isolated. That would allow people to re-enter the workforce, go back to their place of employment, go back to more social settings, social gatherings. And if there is a secondary flare-up because there's no herd immunity amongst the populace and certain patients or certain individuals are not tested and carry the virus and start the spread, and we start to see a secondary wave, that there is suppression mechanisms put back in place to try and stop it before it expands. That's what I think is the most likely outcome. Sectors of the economy that are going to be relatively fine through this, we've got close ties to China. China, whilst no one can trust the numbers that come out in terms of GDP growth or the number of people that were actually infected, they have actually gone back to a lot of manufacturing and working capacity, and there is a lot of fiscal stimulus that has been injected in that economy. And our economy is largely reliant on exports, such as, obviously the biggest is iron ore and the second biggest is coal. And so those will help support the economy. The areas that are going to be hit for the longest, and it's going to be the hardest to get back into the workforce, are obviously those in the hospitality and in the travel and tourism space, because that's going to be dependent on travel restrictions, and is going to be reliant on how soon it is that social distancing is relaxed, and they're allowed to go back to work. And there are a lot of unknowns there, right? Especially in regards to the travel component. We don't know how other governments are going to react, and we can see, in my opinion, a very lax and poor response in the US to the imminent threat. And so, if it lingers around for a while, then unfortunately those parts of the economy might be hurt for a lot longer than other areas of the economy.
Thanks, Dan. So now turning our mind to investment markets. So they were the first sort of to be impacted while life was still fairly normal on the ground here. The share markets were impacted. Where do you see them sort of going from here? What are your highest probability outcomes, and are we likely to see more dips?
I genuinely believe that the highest probability outcome is that we have not seen the worst of this yet, or the bottom of this yet. Here in Australia, we're in a good place. We are in a relatively good place. I feel really bad for the people who have been unable to work, people in the areas like retail, hospitality, travel, and etc. But our investment markets are still reliant on this global interconnection. And I think there's a very high chance of something like a panic sell-off in the US, because the sell-off really was not a panic sell-off. We didn't see the kind of panicked response from investors that we've seen in other sell-offs like the tech wreck or the GFC or 1987. We've seen people be fairly calm and, well, they're sanguine about it, but they are at least reasonably calm about what's going on. If the US if US hospitals and ICU units reach a point where they can't get access to any more ventilators, that they don't have any more beds available, and they're having to start making decisions like they're making in Italy, where they have to decide who lives and who dies, who gets a ventilator and who does not. That could lead to a panic sell-off, and a panic sell-off over there has the contagion effect that it could have one over here. Now, that's not a guaranteed outcome. We may have seen the bottom, but if we have seen the bottom and things rally from here, it will probably be the first time in history that we've seen a sell-off of this veracity, and then just a short, sharp bounce back, and then things continue on as normal. Typically, you see in bear markets a sell-off, not as fast as we saw, but of the magnitude we saw. We see retracements of up to 50, 60% before further legs down. And if you think about the market psyche at the moment, whilst people are reasonably calm, that doesn't mean that they're not worried. And so if there is bad news that comes out in the future, and we don't know what that could be, but if there is bad news, that people's psyche and mindset is such that they're more likely to sell into that strength rather than buy into the rally, because there's just so many unknowns out there, and they're kind of now attuned and a bit shocked by what has happened. And so any bad news is more likely to lead to a sell-off than a buy, but that's certainly not a guarantee. I think the probability is that we will see further lows from here, but that's not I think that's a more likely outcome, but it's certainly not a 100% ironclad guarantee that we're going to see the ASX down around the 4,000 level or something like that.
So going into this, Innova's view and our view was that markets, some markets are expensive. Where do they sit today in your analysis?
Yeah, it's very market specific. So the Australian market started looking expensive to us, which is why we reduced equities, which turned out to be about a month before the virus kind of hit and people kind of realised, which I thought was a bit bizarre, because we were publishing, people were reading the Liberum weeklies. You would have read something from me on the 3rd of February. We were kind of already started to be worried about this. So the Australian market has entered territory as it stands right now, where it's it is reasonably attractive on a long-term basis. It's more attractive at 4,800, which is why 4,700, which is why we bought some down there. But even at 5,200 to 5,300 over a 10-year time horizon, you can expect some pretty decent real returns. Asia and the emerging markets started this sell-off looking at neutral valuation. They are now at relatively cheap valuations, so we're quite happy to continue holding those. But then, and Europe was largely the same. It was looking fairly neutral. It now looks reasonably cheap, but obviously growth is going to be a lot slower. So it's reasonably cheap, but it's not outright dirt cheap that you'd want to go and buy it. The US started out, people look at the sell-off in the US and have asked me questions like, oh, are you going to miss your entry point because of your underweight in the US? And, do you need to buy the US? And I went, well, the US fell 30% like most other markets around the world, but they came from the second highest valuation on well, it depends on the valuation metric you use, but one that we like to use is called the CAPE ratio, or the Schiller PE, the cyclically adjusted price earnings ratio, which takes earnings, the average earnings over the last 10 years, then looks at the price over that, because it's been a very good forecaster of what returns are going to be over the following 10 years. They went from 32, which is the second highest in history. The only other time higher than that was the tech bubble, so even higher than the Great Depression, and fell and have kind of come down to around about 24, 25, which is not much lower than the GFC peaks. So given that the average is about 16.5, the US is still an expensive market. Even at the bottom was still an expensive market. And so that's why our concern is primarily in the US, one, because of their lack of response in regard to the virus, the lack of tools that they've got available in regards to the virus, but also because the market, it's not cheap. And so discretionary buyers, active managers are not looking at this and saying, wow, there's some screaming buys out there for us to go into. they're looking at it going, well, it's still expensive. We don't necessarily want to deploy a lot of capital yet. So, different markets, different valuations.
Yep. Thanks, Dan. Obviously, you guys have been very active throughout this. Could you run through some of the things that you've been doing in your portfolios that you've been taking advantage of and the opportunities out there?
Yeah, absolutely. Yeah, so we don't believe in the whole buy and hope strategy and telling people don't worry, just stay invested all the time, because valuations change and therefore risk changes, and you need to manage that risk. And so leading into this, we did a number of things in those portfolios that had Japanese exposure. We essentially went unhedged, so that was a buy on the Japanese yen. We bought some gold in November. We then bought some more gold in February. In March, we sold out of Australian REITs because of their very high exposure to the retail sector, and diversified that into infrastructure assets and into global property assets that are far more diversified.
And just explain A-REIT. So that's
listed property trusts. So the reason they're called REITs is real estate investment trusts. Sorry. So Australian listed property trusts are very highly exposed to the retail sector, and everybody, you know for yourself, if you try to, drive to a big Westfield, they're shut down essentially. So we didn't want those exposures, and so we took them out of the portfolio. We allocated to some cash. We allocated to some sovereign bonds, even though we thought a lot of the sovereign bonds around the world were expensive. We did it in a very specific way where we used a manager that was buying bonds that were paying a real yield, so they didn't have exposure to the negative yielding bonds in the Eurozone. And since then, late in March, we didn't quite get the bottom, but I think we traded on the bottom was the 19th, and I think we traded on the 20th. We took our first nibble back into Australian equities. We had a budget for Australian equities. We only deployed about 20 to 25% of that budget because we thought that there was only a 20 to 25% chance that this was the bottom. We thought that there was a much greater probability of future downdrafts, and also because we wanted to dollar cost average, because we knew we're not going to be able to time these sorts of things. So we dollar cost average, and we wrote a weekly in regards to the way that we go about dollar cost averaging. Oh, and our most recent move is to essentially buy the Australian dollar. And for those of you, yes, people already have the Australian dollar in their portfolios, but if you have unhedged global equities, you're owning the currencies of those foreign equities. We're moving to a hedged position where those other currencies are being hedged out. And so that's effectively a buy on the Aussie dollar itself, because we think at 60 cents to the US dollar, and compared to, and I don't know what it is off the top of my head, but compared to the pound and to the other and to the euro, it's at levels that it has been cheaper than, but very, very rarely. And it has historically traded on average, at about 30 to 40% above where it is now compared to those currencies. And it may be a couple of years before we get back to those levels, or it could be 3 months. We don't know. But we do know that it shows us an asymmetric payoff profile where the downside, we think if it gets absolutely in the worst, we could lose, say, 16%. But if we just go back to average, we're going to make somewhere between 30 and 40% on that call, just that Australian dollar call.
Oh, great. I know we've talked about a lot of the risks out there and with the US and being able to handle the crisis in terms of beds, but what are some of the things that might surprise markets and give us upside? What could happen? Is it vaccines or
There's a few things. So there's a few different treatments going on in the US. So I listened to and I don't suggest anyone else do this, but I listened to a podcast called This Week in Virology, and each podcast is about 2 hours long, and it's between 3 and 6 virologists just talking about what's going on. And they're looking at things such as the use of plasma from people who have recovered and therefore have antibodies against the virus, and using that either as a treatment. The problem with using it as a treatment is it's a one-for-one treatment. So the amount of plasma you can take from one person's donation, you can only give to one person and give them antibodies. But it can also be taken as a prophylactic. And the real issue in the US that I worry about is the well-being of the healthcare professionals who are overly exposed to this. And if they're able to be given that as a prophylactic, it acts for about 2 weeks, and it can be shared amongst a number of people, and can at least give them some confidence of going to work and not coming home sick, because they're being worked to the bone, and they're just seeing the numbers of people come through the ICU and coming in bad condition at an increasing rate. It's not tapering off yet in the US the way it is everywhere else. But if they're able to provide that and roll it out, which they haven't yet, they've got blood banks ready to go, but the serum hasn't actually been distributed amongst the populace. That could be the good news article. Another one is the use of, everyone talks about chloroquine. Well, the results from chloroquine are still a bit mixed. So they've allowed its use without the general approval and proper protocols that normally you have to go through, because there are at least some anecdotes that under certain scenarios it works. And in fact, there's also the use of steroids at certain stages of the onset of the disease that can be used in conjunction with chloroquine or with other immune suppressors. But they have to be done in a certain way, where they found that if they overlap them, they make matters worse. But if they're provided in the right proportions at certain stages of the virus's cycle, they're actually quite, they can shorten the duration of the virus. And so if there are more, at the moment, that's just anecdotal. If that is proven and reports are written and it is rolled out more widely, that might be the type of good news story that could lead to markets rallying. Our own government coming out and starting to release people back into the workforce early is the type of good news that could help the market. The fact that Italy, Germany, and most of and Spain have seen a reduction in case numbers, once they see a reduction in the death numbers, which obviously lag the number of case numbers, because it takes a number of days after you get infected to then go through the full cycle. I think those sorts of good news articles could help the scenario, but there's also a lot of things that could go wrong as well. In that environment.
Stan, moving away from share markets now, what do, for all of us, with homes, how do you see the effect this having on residential property?
Well, it's fairly common sense, right? So it's a supply and demand equation, and at the moment there's supply and there's reduced demand, because less people have work, and less people have access to the income they need now. They're able to get access to historically low mortgage rates, but if you don't have sufficient income to be able to pay that off, that kind of hurts. And you actually need aggregate demand increase. So somebody moving from a house to a downsizing to an apartment, or moving from one house to another, that's not a gross aggregate in demand. That's just a shift from you're providing supply on one side and demand on the other, so that kind of balances each other out. You need that increase in demand, and we're not going to be getting it from foreign demand. That until the lockdown is released, and we see foreign capital is allowed to be released and come onshore, or our economy start to turn around and people's incomes start to pick up, and they feel a bit more confident in being able to whether buy their first or second home. You need that increase in aggregate demand to come back on stream. So I think that's look, I can't put a time frame around it, but if I was to guess, it could be anywhere from 6 months to 2 years. I would hope that it's towards the shorter end of that scale, that it's only a 6 month slowdown, but I can't guarantee that.
Yeah, thanks, Dan. Also, I know we've touched on commercial property in the retail sector. What effects on other sectors of commercial property do you see, how it plays out for them?
Well, commercial property is very specific to the property itself, right? Because if you own big shopping malls that are heavily reliant on retail, you're in a bit of trouble. But if you own a building that has businesses that are able to work 100% remotely and are still generating revenue and are still profitable and are able to pay your rent, there's not really much that they need to, they haven't been hit. I mean, I know the landlord for Innova Asset Management, we're not going to have any issue paying our rent. We've taken a hit to revenue, and we've all taken a personal hit to our own personal balance sheets because we're invested in our portfolios along with clients. Myself 100%, apart from my mortgage, 100% of everything I own is in the exact same portfolios that our clients are recommended. But the business is still profitable and paying rent. And so if you're in commercial properties in the city that have businesses like accounting practices and the like are able to work essentially 100% from home and haven't had any decrease in revenue or not enough that it's caused any stress on rent, then the rental yields on those properties are doing fine. But then you've got other areas where there's severe stress, where people are not able to pay their rent and having to negotiate with landlords in regards to rent holidays and others. And subsidies from governments will help, but until those businesses are back up and running at some form of profitability to be able to pay those rents, clearly the value of those commercial properties should take a hit. And we've seen some in the industry super fund space where they've decreased the valuation on a number of their properties. I think some of those have been a little bit generous. I don't think the value of their properties have dropped by as little as they have reported, but maybe we'll see a second or third wave of revaluations at some point in the future, because I know that they've got a lot of exposure to areas that have taken a pretty big hit to their revenue line, well, to their rental line.
Yeah. Just touching on industry funds, leading up to this, there's a lot of capital heading towards private equity. What's happened to it so far, and what do you see that playing out?
I think private equity, we haven't seen the hit to private equity yet, but we're going to. I mean, if you think about it, private equity it's public equity, it's just not traded on an exchange. And we saw what happened on the exchange. The value of equities has dropped because corporate profitability has fallen, and corporate profitability will be lower. And so the same is the case for private equity. But the other sting in the tail in regards to private equity was that if you've monitored the institutional purchases, which is something that we do and we have access to because of the data, the price that was paid for a lot of private equity in a lot of these businesses is substantially higher than what you would expect historically. So you think of price earnings ratios and price to book ratios and price to sales in private equity land. You can think of the same sorts of things, and people look at EBITDA multiples. And private equity had its heyday, and a lot of people say, "Oh, look, private equity returns are phenomenal. They're way higher than equity market returns." Well, they haven't been since the mid 90s. They certainly were throughout the 80s, because you were paying 3 to 6 times EBITDA for a business, whereas we saw private equity deals and largely being traded at like at the 12 times margin. And so there's not a lot of margin for safety there if the underlying earnings of those businesses are impaired in any way, shape or form. And so I think there's going to be revaluations of those businesses playing out as GDP drops, because they're heavily linked to the growth of the economy. That's going to play out over the next 12 months or so. It's not going to happen overnight, but I think over the next 12 months, you're going to see some reasonable downgrades, unfortunately.
Thanks, Dan. We just had a question from Adam. So talking back to commercial property, so for office space, do you expect the demand for, the size of floor space requirements will ease because a lot of businesses have experienced working from home and they're making it work, that then we mightn't go back to a situation of needing so much floor space?
Yeah, I think that's a very high likelihood of happening. We've had that debate internally amongst the team. When I said that we're not going to go back to the same economy as it was pre-2020, that was one of the things I was referring to. And I think the same can be said for retail, where people who historically have not bought online, they haven't used Amazon or eBay or things like that. It's just not in their nature to have done so, have kind of been forced to. And so are now getting far more comfortable with the idea of, one, working from home, and two, being able to purchase what it is they require from home. And so I think there's commercial property spaces that have got businesses that have shown that they can run fully from home. There will be some that reduce the floor space and floor size, and there'll be a bunch that don't, because they actually do require the interaction of the teams. And in regards to mental health, it's often seen as a very positive thing for people to be able to actually interact with the various staff. But that'll come at varying degrees, right? Where you might have a business, let's say it's Ernst & Young, that take 8 floors of a certain area, and they now allow people to work from home 1 to 2 days a week, and so only require 80% of the office space. That's not a guarantee, but I wouldn't be surprised if that occurred. And then, but will that office space be taken up by other businesses that are doing quite well? Because there are businesses that have done very well through this and thriving through this, because unfortunately, a pandemic is right for their business model, and they've expanded, and they may need increased floor space. So whether they take up that slack or not, we'll see. But I think it's a very, very real probability, and a very real chance that businesses will operate differently and allow more working from home and more working remotely, because they've tested it and they've found that it works. Our business is a case in point. We're able to work at 100% capacity with nobody interacting, but we will go back to physical location and co-location, because we just we like each other's company, and it's easier to bounce ideas off each other, and you don't talk over the top of each other when you're doing a phone conversation and a phone call and things like that.
Yeah, thanks, Dan. So now moving on sort of from those traditional asset classes like shares and property, I know in terms of alternatives and other opportunities out there, you mentioned, gold is one that you liked, and currency. Is there anything else that you're seeing out there that sparking your interest at the moment?
Yeah, there's a few that we're looking at, and there's a few that we've got exposure to. Managed futures and long volatility. I won't go into the mechanics of what those are, because they're trying to explain long volatility starts to get fairly technical if we talk about the term structure and backwardation of the term structure in the VIX complex. But that is a space that we've had exposure to and has proved profitable for us in March. That's what it was there to do. Managed futures as well was very profitable in March. That's what it was there to do. But even in the credit and debt space, actually is quite interesting. Things like high yield debt and leveraged loans. People are probably not particularly familiar with the leveraged loan market, but they'd be familiar with the hybrid market here in Australia. Well, we saw hybrids sell off pretty viciously here in Australia. There's every chance that could get worse. There's all sorts of iterations of those types of hybrids. So the European version are called COCOs. They came off a lot more. But things like high yield and leveraged loans have come off somewhat, but they've only come off to levels that we saw in, like the European crisis of 2011 and, early 2016 after the Chinese yuan devaluation. So they're certainly not at panic levels, but they were in the GFC. They were being sold off in the GFC at levels where you could pick up the debt of investment grade companies or sub-investment grade companies that were in perfectly good shape and perfectly profitable at 30 cents in the dollar. And they proved to be very, very lucrative if you picked them up at that panic point. And so we have isolated particular areas that we think if there is a secondary sell-off and if there is panic selling, if they hit those triggers, if they hit those sorts of levels that they did in the GFC, the returns that can be generated from those instruments are actually far superior than what you could get out of equities, even though they are further up in the capital structure and therefore are lower risk. And so whilst equities might become very attractive, these sorts of debt instruments might be even more attractive. And I'll give you an example. There's one offering that did minus 27% in the GFC, and then in 2008, and then in 2009 did 79%, in 2010 did 25%. There was one that when we were back at an old shop that we worked at, we recommended to clients in early 2009 to actually allocate some of their equities to a global income manager that had access to high yield and to leveraged loans. And the subsequent 12-month period made 72%, I think it was, and then 20 the year after. And so we're looking at those sorts of areas, and the cocoa bond market as another area that we're trying to find managers that are able to. We wouldn't do it passively. and we wouldn't just allocate to that space via an index. We would find managers that can pick those companies that are being sold off indiscriminately, along with the ones that should be sold off because they are going to default, and allocate to them because the return profile is very, very attractive. It's completely asymmetrical and could pose an exceptional opportunity. That and finally the energy sector. I mean, we all know what Russia and Iran are trying to do to the US shale space, but you know, energy and oil, it's had a bit of a bounce, but you know, Brent at $30. There's the low cost producers who are profitable at $30, but they're not highly profitable. And areas such as Iran, who are and even Russia, they're both low cost producers, and they're able to be profitable at, you know, $20 oil, but their government and their economies are so reliant on that sector. The way that we have, you know, 44 to 48% of the, you know, the Australian market is made up of the banks, and, you know, 15 to 18% is materials. Well, they've got, you know, 50 to 60% of the revenue profile of the overall economy is relying on oil. So whilst the oil producers might be profitable, but they're not profitable enough for the government to be able to fund any kind of surplus or even maintain a sufficient level of debt. And so, you know, at some point, the demand for oil will come back on stream as people travel more and they use their cars more and they fly more and etc. And shipping routes are reopened. So the demand will come back on stream, and the supply side, there will be some consolidation where things move from weak hands to strong hands, and supply will be able to come back on stream to meet that demand, but it won't come back on stream at stupidly high levels because they will want the price to increase to be more profitable. And so we think the energy sector is somewhere that we're looking at very closely and could become a part of client portfolios. It's very specific, so it may not be, and it's very, very volatile and very political, so it may not be, but it is also very interesting.
Thanks, Dan. What we might do now is, if anybody has any questions, you can either, there's a chat box, should be in front of you, you can type it into, or if you hit the button that says raise your hand, I can unmute your microphone so you can ask it. But as before we wrap up, does anybody have any questions they'd like to ask, pick Dan's brain about? Just give it a little bit more.
Yeah, feel free to ask anything, guys. Like, I'm more than happy to talk about, you know, government responses, programs, what I believe should be done in areas like the US, the risks I see in the US and the lack of response. You know, why Asia, you know, why Singapore, South Korea, Hong Kong seem to be able to do much better through this than other areas. You know, I've spent a lot of time understanding doing my best to understand the epidemiological models of this, as well as the virological impact and the science behind it. And you know, I thankfully have a bit of a unique background in that I can understand some of what they're talking about.
I can't see any questions coming through, so you've done so well, Dan. That here we go.
I put everyone to sleep.
All right, I've got one from Craig, so I'll just allow you to talk. Here we go. Should be able to just unmute your microphone, Craig. And there you go. You should be able to talk.
Probably not quite the question you're looking for, but one of the things I'm interested in is the government's doing a lot of fiscal lending and giving away money to retirees and people who are on the dole and so forth. But there's nothing coming in any shape or form that will help a self-funded retiree who has residential property, industrial property, and shares. You end up with not just a negative income. Well, a negative income is what you end up with. You've still got all your assets. Nothing's coming at you. Whereas I just wondered if you had any insight as to what you think the government might do, or am I barking up the wrong tree that we're going to get any help at all and just keep on?
Unfortunately, the government's got fairly blunt instruments to use. And so the one thing that you've kind of alluded to, but isn't much talked about, is the incentives there's actually incentives for businesses to lay people off and then take take on certain schemes to be able to boost their revenue. And so do I think the fiscal stimulus has been targeted in the way that it should, and that the people who need the help and require the help are going to get the help? No. It's certainly not perfect. And your comment that there is essentially nothing for the self-funded retiree is 100% correct. But that's not to mean that they won't recognise that at some point in the future and do something about it. I guess everything has happened so far. Well, I don't think it's happened so fast, because I was kind of thinking about this in January and started writing about it in February, which is why I'm really confused as to nobody in the major government started talking about it until March. I mean, they had the same information I did, but anyway. I guess they've had to react so fast. They've reacted in a very blunt way. We saw that, the initial stimulus package, is more than doubled since then. And so I don't know as to whether they will recognise the gaping hole in what it is they're trying to achieve, and that self-funded retirees are not getting any benefit from this in any way, shape or form. And in fact, they've created incentives in areas that they probably don't want to create incentives in. I can't promise that the government will recognise that, but I'm sure that there are lobbies. Well, I know that there are lobbyist groups that have posted submissions to them in regards to this sort of thing. Whether or not they act on it, I don't know. I don't have a direct line to Scott Morrison, and even if I did, I doubt very much he'd tell me the truth.
Thanks for your answer.
Thanks, Craig, and thanks, Dan. I just had another question just come through. So, in terms of specifically bank shares and the impacts on them, how long do you see them being impacted? With the potential for interest-free loans, loan deferrals, businesses defaulting, those types of things. And at current prices, are they attractive, or is there more sort of pain to come? What are your thoughts?
I'm not a stock picker, so I don't value individual banks, and so whether or not they're attractive, these prices, and that everything that you've outlined is already baked into the price or not, I can't talk to. What I can say is that how long do I think the effect and hit to their revenue line will last? I think it will coincide with how long the depression in GDP growth will last and the residential property market will last. And as I said, I thought that was something in the vicinity of 6 months to 2 years. But there's a lot of variables that go along with that. And the reason why I said there's a lot of unknown variables that go along with that. And what I mean by that is what the subsequent response is going to be from the government when they allow people to start to reduce the social distancing and going back. I mean, we're all in complete lockdown, right? So one of our employees, they've got friends who have been pulled over on the street by the police asking where they're going and why they're going there, because they're not allowed out of their house unless it's for education, it's for medical or essential supplies, etc. Once the government starts to relax those social distancing components, if they have efficient testing, which Scott Morrison has come out and said we have one of the world's best testing regimes, that is absolute rubbish. That is complete nonsense. I doubt anybody on this call has been able to go and get themselves tested, because the only way you can really do it is to lie and say that you've been exposed or you've had these certain symptoms or whatever the case may be. And the testing centres, there are some out there, but there's not enough, and they are backed up to the hilt. And I know that it's the type of thing that you should expect a turnaround in a day. I can tell you it takes 3 to 4 days, because if there's nobody on the call who hasn't been tested, I'm the one person who has been tested, because my daughter shows symptoms, and my wife managed to convince the doctor that I was in contact with international fund managers and that had come from overseas, which so I was tested as well, and it took 4 days for the test results to come back. But as people are released back into the system, if they have more efficient testing and are able to track and trace people who are shown as positive, then this could be a very short period of time. We're able to manage it quite well. However, if they allow people back into the economy holus bolus and social distancing is not enforced. I mean, we saw in Manly here in Sydney, people, going to Manly Beach, under the guise of, oh, it's exercise, therefore they weren't, following the social distancing requirements. That's just stupid. That's just dangerous. And they had to shut Manly on Sunday because of it. If we have a second wave of infection because of those sorts of things, if people don't follow decent protocols of, keeping their hands clean, if they show any types of symptoms, self-quarantining themselves, of people who are testing positive, tracing back as to their contact points and having them quarantined, if we are released back into society and there is no one vaccine, and there's probably not going to be one on the market for at least 12 months, or two, there's no herd immunity, and that's not likely to occur until epidemiological forecasts are somewhere between 60 and 80% of the populace has to have been exposed before herd immunity is in place. And it also assumes that there's no secondary infection, because this virus has mutated, I think, 6 times so far. We were originally talking about the S strain and the L strain. There's now more strains than that. The strain they have in the US is far different to, well, it's not far different. It's only minorly different, but it's different to the one we've got in Australia, but it is a lot more aggressive than the one that we've got in Australia. If we have a second wave of infection, then that 6-month period that the banks are exposed to businesses that are not able to pay their rent, and they have to provide residential mortgage extensions, the time it takes for them to recoup that, because the extensions aren't, I mean, they're a holiday, but they're capitalized in the principal and interest, so they still have to be paid back. The time it takes until people are able to afford to pay that back is what is going to determine how long it's going to be until the banks are profitable enough, or get back to the same sorts of levels of profitability. And like I said, that could be anywhere from 6 months to 2 years because of these unknowns, this secondary wave effect that could occur that I think everyone should be aware of. And, I'm very surprised people aren't talking about. But whether or not that's already baked into the price, I don't know. I don't analyze individual stocks, because the difference I can make to clients' portfolios is completely dwarfed by the asset allocation risk management completely dwarfs anything I can do by valuing individual companies and getting it right or wrong. And the simple history shows that more people get it wrong than right. So I'd be extremely arrogant to assume that just because most of the people in the world who are as intelligent and as educated and as experienced as me get it wrong, I'm going to get it right because I'm somehow special. And there was one thing actually I think is worthwhile talking about that is not, and is completely off topic, so I apologize, but I haven't heard this in the press, but I can't get over the fact that there's a presidential election in November 2020, and the candidates are going to be on their campaign trail, and they're going to be meeting with thousands upon thousands of people, and potentially being exposed. Everybody's over the age of 73. They're 73, 77, and 78, and that's a very high risk category. They're the categories that, if you follow the North Korean and Singaporean guidelines, or the Hong Kong guidelines as to what you do, you don't, if you're in that high cat, if you're 70 years and up, you need to wait until case count has reduced significantly, and the spread of the infection is reduced significantly before you enter back into the populace, especially in a vast social setting like a presidential campaign. Like I still can't get over that. That's not. I haven't seen anything in the press about it. I haven't heard anyone else talking about it. So, if I can pick it up, I'm sure other people can pick up on it.
Mm-hmm. No, absolutely. I just had one other question from Nadia, which is very interesting. So, considering a lot of our we import a lot of products that we consume from places like China, do you think that this will impact how we do business and where we buy from, and there'll be a switch to Aussie-made goods?
Excellent question, and the answer is absolutely, and that will happen globally. That will happen everywhere. I mentioned earlier that there are some of the impetus, some of the ingredients baked into the cake for future inflation. One of them is the diversification of supply lines. So leading up to February, the decade-long trend was to consolidate your supply line because you get economies of scale and lower prices. but then it's shown the reliance that we've got on single supply chains. And example of that is in the US, 90% of their pharmaceuticals come from China, right? And face masks come from 2 different places, and have a guess where they are. One of them's China and the other's Italy. So I think absolutely that businesses will be reassessing where they get their supplies from, and this will happen globally. I think there will be more and more people will try to do things domestically, but also to diversify, to have multiple supply chain links, because it just de-risks your business. It might increase the cost, but it de-risks the business somewhat. But nobody would have, having a single client having a single supplier is the same as having a single client. It's just not a good business, because if that client decides they don't want to use you anymore, well, you're out of business now. If you have a single supply chain and that supply chain shuts down, well, that you're in trouble. Here in Australia, at the very start of this, we started very early in February. So even before at the very start of the market fall, I spoke to, and I can only talk anecdotally because I can't, I don't have contacts in every manufacturing and whatever business there is in Australia, but I try to get in contact with, or at least get secondary information through people I knew. I had contact with people that did things that required raw inputs from China. So things such as meshing and fencing for play areas in public areas. Shipping containers requiring raw inputs for the manufacturing of certain goods. And they said that when I spoke to them in early February, they said, no, since January, we haven't been able to get a thing. We haven't, we've got demand for our business, but we don't have anything to actually supply them with. 3 weeks later, I spoke to the same businesses, and all of them, one of them in particular said, oh, we got our first shipping container today. It was full, and every other shipping container we had on backlog is due in the next 3 days, and we will have the entire amount. We're up and running, going 100%. That's actually one of the good things about Australia having supply lines back to China, in that China, because of the way in which they were able to contain things, which we obviously can't do, they can. They were able to get back up to some level of manufacturing and some level of capacity for their economy. Now they've taken a hit; they're not back up at 100%. One of our staff members is every day calling either a friend or a family member in China to get a lay of the land as to what's happening with what they're doing and how they're keeping things contained whilst still trying to promote people to re-enter society. And so we have a direct line back to people on the ground in China to find out what's going on there. And then we also have spoken to people about the supply chains and what that has done for them domestically. However, I know that they had a couple of week period where they didn't have access to anything. So they will have in the back of their minds, holy hell, we need to have diversified supply chains, otherwise we're in trouble. Particularly if you were trying to get it out of China and it was only 2 weeks, it's less of an effect. But if you're in Germany trying to get stuff from Italy and you can't get access to anything for 2 or 3 months, well then you really want to take a closer look at what's going on. Same as certain supply lines out of the US. Ventilators, they can't get enough ventilators, so there will be more buy Australian, develop Australian. That'll be the same as buy German, develop German, buy US, develop US. There will be a lot more of that, and that leads to an increase in the cost base, because you can't consolidate into a single supply line and use your economies of scale to get lower prices. And that's what I mean by it being part of being baked into the cake of potential future inflation when we come through this on the other side and stimulus has been given to people, and people go out and they want to spend and they genuinely want to just get re-engaged, and you then have companies that have an increased cost base passing it on in the form of higher prices. That's inflationary. And so whilst it's not a surefire thing, and I don't think we're going to see it in the next 6 months, we certainly could in a year or two's time, which is why we have certain inflationary hedges in our portfolio just in case that occurs.
Right. So that's been about an hour. So thanks, Dan, for those insights. They've been really great. And thank you all for joining us. A recording of this webinar today will be made available to everyone via email. If you have any concerns or you'd like to talk further about anything Dan's covered today, please don't hesitate to give me a call. So thank you, everyone, and have a happy and safe Easter.
Yeah, thank you, everybody. Appreciate your time.
See you later.